Like a slap in the face. Hi, Dean Jenkins with FollowMeTrades.com, and I'm not talking about Will Smith and the episode with Chris Rock at the Oscars last night. And I don't watch the Oscars. I frankly don't care about the whole thing. I like the movies I like. I watch the movies I like. Right? But I couldn't help but be aware of the incident last night. Right? It is everywhere you look. And this update is not about Will Smith or Chris Rock or the Oscars. If you're interested in that, you can go on social media, Twitter, Facebook, whatever, and there's plenty of opinions. But here's another slap in the face that you might be interested in, and it is the yield curve inversion. Here's an article from CNBC. And it says, hey, the bond market is flashing a warning sign that a recession may be coming because the yield curve has inverted. And what that means is shorter term rates are higher than longer term rates. Normally, longer term investments, treasuries, have a higher yield than shorter term. The big deal is when the 2-year gets below the 10-year. We're not there yet, but the 5-year just went below the 10-year, and that's kind of a warning sign. And it's flashing, say, hey, if it continues and the 2-year goes below the 10-year, you get a higher rate on a 2-year investment than you do on a 10-year investment. That could it implies. It signals a real lack of investor confidence in the economy, and maybe a warning sign of a recession. And a recession is defined as 2 consecutive quarters of negative GDP, gross domestic product growth. So what has the GDP been? Well, here's a great site, Forex Factory. They have all the upcoming big deal economic reports. And on Wednesday, March 30th, we're going to get the final GDP quarter over quarter. What's it been? Well, I hope you can see this, but in September the report came out. It was forecasted to be 6.6, came at 6.7. That's really good news. And in the fourth quarter, December 22, it came out, huge drop from 6.6 to an actual of 2.3. So if we get now this report coming out on March 30th, Wednesday, at 5:30 a.m. Pacific time, 8:30 a.m. Eastern time, if it is down as well, what does that mean by definition? The R word, recession, not good, means declining economic growth in the United States. Let's look at the S&P 500 chart, because this is super interesting. I'm showing 2 years worth of data here. Of course, when the pandemic started, the market dropped big back here. And since then, it hit a bottom and had really nice, steady rally all the way up till the beginning of 2022. And then it started down again. It actually entered correction territory, a bear market, 10% correction. And it's come up since then. Last couple of weeks, it's come up pretty strong. It is above the 200-day moving average, this thick white line. It's above the 50-day moving average, this lighter gray line, above the Ichimoku cloud. It is approaching, when we had this correction, we had a low, we had a lower high, we had a low, came back up and found what's called resistance up here at this level. I'll zoom in a little. Right, came up to this point, reversed. Came up to this point, reversed. We're approaching that same price level, and it's going to coincide with the GDP report on Wednesday, pretty much. And so if the report is good, we're not in a recession, we could take off and go to new highs, challenge this high. if it's bad, and if we're in a recession, look out. Look out below, man. This thing's going to reverse and head down. That, nothing's certain in the market, but that is highly probable. So that's something to watch for and something to be prepared for as we trade. Various, trade the indexes, trade various stocks, right? Some stocks do well in a recession. They call it consumer defensive and various, flight to safety and all these kind of terms. Those can do well, so there can be long opportunities. But some other stuff, particularly highly volatile stuff, technology, stuff like that, can provide some great short opportunities. So we're approaching a super important point here. And, like I said, the fact that the 5-year is higher than the 10-year is a baby slap, a little tap. If the 2-year gets under the 10-year, that's a whack. And that has historically signaled the start of a recession, and we'll see how the GDP numbers come in. But it's certainly worth watching, and it's important to be aware of as traders. So watch for that, and we'll continue to provide updates as it plays out. Thanks.